World War I was not just a war of trenches, alliances, and empires, it was a war of balance sheets. In this Q&A, we extract key insights from Broadberry and Harrison's landmark overview, translating the dense economics of war into a clear breakdown. Each answer incorporates critical mechanisms, monetary, logistical, and industrial, that explain how resource flows determine battlefield outcomes. Alongside GDP and casualty figures, we also analyze the invisible levers: capital stock depletion, financial center migration, and the collapse of multinational empires into currency-fragmented zones. Title: Why Germany Couldn't Afford to Win World War I. Question: What was the economic imbalance between the Allies and Central Powers at the start of World War I? In 1914, the Allies had 5.4 times the population, 11.5 times the territory, and 3 times the total GDP of the Central Powers. However, the Central Powers had higher GDP per capita, indicating greater economic development per person, but far fewer aggregate resources. Question: Why did Germany believe it could win a war against such economic odds? Germany's war plan, the Schlieffen Plan, was to knock out France quickly before Russia could fully mobilize. It bet on speed, surprise, and short-term military superiority to avoid a prolonged economic conflict. Once this failed, the war became a resource-based war of attrition. Question: How did the entry of the United States change the balance? In 1917, Russia exited the war while the US entered. This replaced the poorest Allied great power with the richest. United States GDP was over $500 billion in 1990, more than double Russia's, and its economic contribution shifted the balance decisively toward the Allies. Question: What happened to the economies of the major powers during the war? Britain and the US saw GDP growth of 10 to 13%. France and Russia collapsed by 1917 to 1918. GDP fell over 30%. Germany and Austria-Hungary experienced sustained economic decline, with GDP 20 to 25% below pre-war levels by 1918. Question: Why couldn't Russia or Austria-Hungary leverage their large populations? Their economies were dominated by subsistence agriculture. Peasants withdrew from markets when industrial goods became scarce, leading to food shortages in cities and economic disintegration. Russia, in particular, suffered from what was described as peasant secession. Question: Did industrial strength or military tactics matter more in the end? While military competence mattered early on, over time it was economic capacity, measured in GDP, supply chains, and industrial mobilization, that proved decisive. Germany's 1918 spring offensive failed partly due to lack of supplies and soldier exhaustion. Question: How did war impact the domestic economies in terms of government spending? By 1917, governments in Britain, France, and Germany were spending over 50 to 60% of national income on the war. Italy peaked at 38%, while the United States, which joined late, spent 17% and lent another 5% to allies. Question: What were the direct and indirect economic costs of the war? Britain spent $44 billion, Germany $40 billion. Total direct costs exceeded $186 billion. Indirect costs: human capital losses, property destruction, shipping losses, added $150 billion more. France and Germany both lost over 50% of pre-war national wealth, when combining physical and human capital destruction. Question: How did the war change post-war economic power? Britain liquidated a quarter of its overseas investments. Germany was saddled with reparations equal to over 50% of its pre-war capital stock. The global financial center shifted toward the United States, and economic disintegration in Eastern Europe set the stage for World War II. Question: What is the main economic lesson from World War I? Total war in the industrial age is won not by strategy alone but by resource depth. Once a war becomes protracted, the side with more industrial capacity, stronger logistics, and higher average development is almost guaranteed to outlast the other. Extended explanation: How the global financial system was rewired by World War I. Question: What were the financial and geopolitical mechanisms behind Britain's asset liquidation, Germany's reparations burden, and the rise of the United States as global financial hegemon? This transition was not accidental. It was a direct consequence of wartime funding demands, disrupted trade flows, and post-war imbalance. Here's how each major outcome unfolded. Britain's liquidation of overseas investments. Pre-war Britain was the world's leading capital exporter, holding vast equity in railways, mines, and bonds across its empire and the Americas. With war came deficits. Britain needed US dollars and gold to buy food and weapons, so it began selling its overseas portfolio, especially US securities. Result: a roughly 25% decline in net foreign assets. The City of London lost dominance in global credit and trade finance. 2. Germany's reparations trap. Treaty of Versailles imposed reparations of roughly 132 billion gold marks, roughly $33 billion, equal to 51.6% of Germany's pre-war capital stock. These obligations had to be paid in hard currency or in kind, coal or ships for example. But Germany had lost its colonies, merchant fleet, and access to credit markets. Germany printed money domestically, leading to hyperinflation between 1921 and 1923 and reliance on foreign loans, notably from the United States. Result: macroeconomic instability, breakdown of domestic savings, and loss of investor trust. 3. Shift of global financial center to the United States. The U.S. emerged from the war as the world's largest creditor, over $10 billion in loans to allies. Gold inflows made the U.S. dollar a de facto reserve currency. By 1920, the Federal Reserve System and Wall Street underwrote major sovereign lending. New York overtook London as the hub for bond issuance, FX settlement, and trade invoicing. Result: global capital markets pivoted westward. The dollar became a key invoicing and settlement currency by 1925. 4. Eastern European disintegration. The collapse of Austria-Hungary and the Ottoman Empire created numerous new states, each issuing its own currency and imposing trade barriers. With little gold, no central financial institutions, and protectionist instincts, these states defaulted to fragmented, inflation-prone regimes. Cross-border capital dried up, intra-regional trade collapsed, and ethnic nationalist policies worsened the economic fracture. Result: Eastern Europe entered the 1930s with low capital formation, weak institutions, and high susceptibility to extremist politics. In total, World War I rewired global finance by dismantling creditor empires, bankrupting combatants, and crowning the United States as the new anchor of capital and credit. The war wasn't just fought with rifles, it was won with reserves, remittance routes, and restructured ledgers. Source: Broadberry and Harrison, The Economics of World War I, An Overview, 2004. The content in this media is based on a working draft by two leading economic historians, Stephen Broadberry and Mark Harrison.